On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope everyone is well. That's another week behind us and it was another volatile one, wasn't it? Now, despite a strong rebound on Friday in the US, the S&P 500 index still finished the week 1.9% lower. Now, I think the reason for that rebound was that we had a speech from John Williams from the New York Fed. Now, remember the Federal Reserve has a meeting coming up in December, and Mr. Williams said that interest rates might see, and I'm quoting him here, further adjustment in the near term. So markets took that to mean, well, there's probably a cut coming. And that saw odds for a cut in December jump from 42% before, that's where they're at on Thursday, right up to 75%. So I think that's the reason why we did see a rebound on Friday. I think rather than people reacting to that Nvidia result from earlier in the week, or rather than people being all of a sudden not concerned anymore about the AI trade and where valuations have got to, I think it was some of that uncertainty around what the Fed may or may not do in December that was alleviated because of Mr. Williams' comments. So now 75% chance of a rate cut back on for December in the eyes of financial markets. So the S&P 500 index down 1.9% last week. It's about 4.2% below its peak, and the tech sector is lower again. It's down about 10%, some stocks more than others. The likes of Google and Apple are holding up very well. I think Meta, Facebook, is down about 25% from its peak. So it depends where you look. Bitcoin, the other asset that stands out, Bitcoin prices have slumped 32%, so a big fall there. But that is just part and parcel if you're in the crypto market, isn't it? So certainly not the first time in recent years that we've seen Bitcoin prices fall to that degree. Elsewhere, European shares, UK shares down as well, down 2.6% and 1.6% respectively. The Japanese market down 1.8%. Emerging market equities, more volatile than most, down 3.7% during the week. Now remember that emerging market shares have been the top performer this year. EM shares are up 24% ahead of everybody else. Closer to home, the ASX 200 down 2.5% and the local NZX 50 down just 0.3%. So held up very well, much more resilient, as is often the case. We don't have those tech stocks. We have lots of safe and steady infrastructure, real estate, healthcare, utilities, all of those sorts of companies. And as I said in a podcast episode last week, because we're still 13, 14, 15% below our record high from back in 2021, our market is valued more modestly than some around the world, and we haven't had that big run in recent years. So maybe that's playing into our outperformance while we've seen the sell-off. Interest rates, the US 10-year Treasury yield fell to 4.06%. That's the lowest in 3 or 4 weeks. The domestic 5-year swap rate rose slightly up 5 basis points, so finished last week at 3.19%. In terms of some of the key releases, we did see a string of delayed US economic releases come out last week. The big one was the September jobs report. And good and bad, we saw 119,000 new jobs created for the month. That was above expectations. It was the strongest in 5 months. In contrast, the unemployment rate inched higher to 4.4. That was up from 4.3, and it was the highest we've seen since October 2021. Remember that the jobs report, there are 2 surveys that feed into it each month. So that's why you sometimes can see conflicting measures when that jobs report comes out. This one didn't get as much attention as it usually would because it was several weeks late, and it's sort of looking like old news now. What wasn't old news were the flash PMIs for November. These are very up to the minute, and we got these for Japan, Australia, the UK, Europe, and the US. So this was really useful, particularly in light of all those delayed US economic releases that we haven't seen. So pretty good. It was solid across the board, all the major regions above the break-even 50 level, even though we did see a bit of slowing momentum in places. Europe looked strong. The composite PMI little changed at 52.4. That's pretty close to the highest in 2 years. Australia and Japan hit 3-month highs. The UK was soft. The composite PMI there fell from 52.2 to 50.5, and it was the services sector that seemed to be slowing more than expected. The US was strong, which is comforting. Business activity growth up for the second month in a row. We saw the largest rise in new business so far this year, and confidence in the year ahead also improved. So firms are reporting less worries than before about the policy environment, and there's actually a little bit of optimism out there over increased policy support. So not too bad across the board from those flash PMIs for the month of November. Here in New Zealand, we got a housing market report, and again, some green shoots, so that's positive. This was for the month of October. Activity up. Prices rising slightly, so sales volumes were up about 15% from September. The days to sell slipped again from 43 to 41. That's at a national level. And on the pricing front, the National House Price Index up 0.6%. That was the third monthly gain in a row, and we've seen the strongest 3-month period now since late last year. So prices have edged back into positive territory year to date after being negative for a long time. They're still 15% below the peak from late 2021, but at least we're starting to see a little bit more optimism across the housing market. We don't want to see too much optimism, but stability is something that we should be looking forward to and encouraged by. Less positive was the latest dairy auction. No reprieve for the ag sector. The headline GDT index fell for the 7th consecutive time. Prices were down 3%, and I think a lot of it is to do with increased supply. We've seen strong milk production right across the world, and I think that is what is weighing on prices. So the headline GDT index is now 18% down from the 3-year high that we saw in May, and it's almost 10% lower in 2025. So unsurprisingly, we've started to see economists begin paring back expectations for what farmers will receive this season. So ANZ Bank, as an example, they had $10 as an estimate before. They've revised that down to $9.65. So we'll just have to watch and see how the pricing, demand, and supply environment develops on the global dairy front. Right, turning to the week ahead, and we'll start offshore. It will be a holiday shortened week in the United States. Markets will be closed on Thursday for Thanksgiving, and then there's an early close on Friday. So I suspect you'll see a lot of market participants take the day off on Friday. It's only a half day anyway, so it'll be pretty quiet, and a few people might head off early on the Wednesday as well. So it will kind of be half a week. Markets will still be open and trading on Friday, but expect reduced volume. So a little bit quieter. We will continue to see some delayed economic data come out. We'll get the September retail sales report, the September durable goods report. We'll also see the Conference Board's Consumer Confidence Index. That's not delayed. That would have been out this week anyway. And we'll also get the Fed's beige book. So a few things to watch in the US, but here in New Zealand, it will be a monster week. The main event will be Wednesday's OCR decision and monetary policy statement from the Reserve Bank. Now, these are released at 2 o'clock on Wednesday, and they will be followed by a press conference at 3 o'clock. So you go on the Reserve Bank's website and you can watch that press conference live. It's also posted on their YouTube channel a day or two later. So 2 o'clock they're all released, all the documents and all the materials. 3 o'clock you dial in and you watch the press conference. Now, the Reserve Bank has cut rates 8 times this cycle. We started at 5.5%. That was a 15-year high, 5.5%. Now we're at 2.5%. Markets are expecting another cut this week of 0.25%. That is fully priced. It's a done deal. That will take the OCR to 2.25%. Now, what happens after that is more difficult to say. Financial market pricing implies about a 50-50 chance of one further cut next year, taking us all the way down to 2%. But that will probably depend on how the economy develops. We'll also have a new governor on board next year, and there's a bigger than usual gap between this Wednesday's meeting and the next meeting, which doesn't come until mid-February. So some economists out there think that this week's cut could be the last one. And I can see why they would believe that, because interest rates have come down a long way. We are seeing signs of improvement. Mortgage rates have fallen dramatically. At some point, that will feed through to households as people roll off their fixed rates and onto the lower rates. I've got a couple of mortgages coming up for renewal, and I'm on, I think, 5.59. And the current rate is like 4.4. So it's a big gap down, and you extrapolate that right across the country, and it will provide a lot of relief and stimulus for households. So in that 3 months between this week's meeting and the mid-February meeting, you could see a recovery begin to take hold. And if that's the case, this week's cut might be the last one, or the recovery might be more subdued than we're all hoping for and expecting, as has been the case all year. So we'll just have to wait and see. The forecasts that will come out with the MPS, the Monetary Policy Statement, will be closely watched. I think the Reserve Bank will hedge its bets. So in that forward OCR track, I think you'll see it bottom out at about 2.1, 2.2%. Now, you don't get an OCR that is sort of in the middle. They move in 25 basis point increments, but putting that track going down to somewhere in the middle of that range would sort of signal we'll cut again if we have to, but if things go okay, then we might not. So Wednesday afternoon, that will be really key. What else we got this coming week? We have got a retail sales report for the September quarter. That is out on Wednesday as well. It'll be earlier than the Reserve Bank. I think that retail sales report out at 10:45. And then the ANZ Business Outlook survey for November as well. That is out on Thursday, I believe, at 1 p.m. Now, last month, we saw a nice jump in headline sentiment up to 58.1. That's the highest in 8 months. We saw a more modest increase in the own activity measure, but it was still up, the strongest since April. So we'll be watching to see further evidence of improving confidence and more indicators that firms are getting a little bit more upbeat as the green shoots come through. There's also a lot to watch on the earnings front and the corporate front here in New Zealand. We've had a string of company results over the last few weeks, and there is more to come this week. Two of the real heavyweights of the local market are reporting. Fisher & Paykel Healthcare on Wednesday, our biggest company on our market, and then on Thursday, Ryman Healthcare, which is a company that has had a fairly mixed performance in recent years, and there's been a lot of new capital raised. There's been a complete refresh at management and board level, but a lot of people out there are more upbeat on Ryman as you start to see evidence of the housing market improve. It's still very leveraged to where the property market goes. So Wednesday and Thursday, FPH and Ryman. Also Gentrac, Kiwi Property, Pacific Edge, NZ King Salmon, Tower, Raycon, and a warehouse AGM. So lots to watch right through the week. Internationally, it's a little bit quieter on the earnings front, but we will have a result from Alibaba on Tuesday, so that will be interesting to watch too. So that's this week. That's last week. Take care out there, everybody. We had a volatile week last week, and I know we did see a recovery on Friday in the US. So New Zealand, Australia, Japan, that were all closed. When that took place, we should start on the front foot this week, and it should be a good start to the week. But I'm not so sure that the volatility is completely behind us. I think there could be some more ups and downs ahead, especially as people continue to question where those valuations across the tech sector, the AI sector should be, where they deserve to be, and there could just be a little bit more of a shakeout to come. So stay safe, but take opportunities where you see them. All right, thanks for listening, everybody. We'll talk again soon.
For more insights, visit craigsip.com.